Investors, welcome to the High Class Dividend channel. Today, with this first video, we begin a journey into dividend growth investing. My goal here is to help you build a portfolio that grows income, protects wealth, and gives you financial freedom over time. If you believe in consistency, discipline, and cash flow, you are in the right place. Let's get started. First things first, disclaimer. This content is for educational and entertainment purposes only. I am not a financial advisor. Nothing in this video is finance, legal, or tax advice. Always do your own research and consult a licensed professional before making investment decisions. The agenda of today. We are going to take a look at the definition of DGI, what are its advantages, at least for me, and what is the profile of companies present in this realm. Now, DGI is nothing more than a long-term strategy based on investing in high-quality companies that not only pay dividends, but increase those dividends every single year. If we take a look at Microsoft, for example, it has paid $0.50 in dividends in 2006, and because it has increased its payments ever since, it is now paying more than $3 a share, which is 6 times the value of the 2006 payments. And how is this different than regular dividend investing? Let's take a look at the dynamics of our dividends cash flow. What we receive is nothing more than the dividends paid by share by a company multiplied by the number of shares we own. Now, non-dividend growth companies pay irregular dividends over time, some years more, some years less, some years no payments at all. We use these payments to buy more shares, and because we own more shares, our total dividend cash flow tends to increase over time. Here's one example. Petrobras, the oil company from Brazil. We can see inconsistent payments over time, initially stable but not increasing, some years without a payment at all, and some random spikes later on. So how would be the cash flow dynamic for dividend growth companies? First and foremost, these companies keep on paying us increasing dividends per share. This increase in income we receive will sponsor the acquisition of even more shares because the money used to buy them keeps growing. So finally, if both components of the equation are increasing, our total dividends cash flow will increase much faster than regular dividend investing. This is the real snowball. We reinvest our dividends and we get increasing payouts. Okay, so why do we like this so much? First advantage is that DGI as a strategy already filters out most bad companies from our radar. We will understand why. Let's take a look at Snap-on. As any other dividend growth company, it has been increasing its dividend payments over time. The problem is that dividends can be increased over time sustainably only if also earnings are increased over time. This because dividends come from part of the earnings, at least for most companies. Increasing earnings every year or almost every year is difficult. Not every company is capable of such. Therefore, if my investable world is made of only companies capable of doing so, it gets more difficult to make bad investment choices. Still, there are bad dividend growth companies, but they are an exception, not the rule. In this channel, we will try to make it easier to spot them. Second advantage, dividend growth companies tend to outperform in the long term. This here is a study performed by Guardian Capital, and they have separated the S&P 500 company into these 4 groups: dividend growers, dividend payers without a change, non-dividend paying stocks, and dividend cutters. We clearly see that by focusing on dividend growth companies, we are not sacrificing price performance. This study shows quite the opposite. Now, I have seen other versions with different clusters where they show that from 2024 onwards, pure growth companies have surpassed dividend growth companies. But to me, the conclusion does not change. We are not jeopardizing price performance because we are focused on dividend growth companies. But here I have to add an important point. Dividend investors don't seem to understand. Those companies outperform not because they pay dividends. Dividends are not the cause of value. Dividends are the consequence of value. The value lies on the actions a company takes in order to sponsor earnings growth, which will later fund dividend growth. Those companies are not good because they pay dividends. They pay dividends because they are good companies. Moving on. Dividend growth companies are easier to hold during red periods. Growth investors and many others will be focused on price performance, in the end, because that's all they can count on. And during bear markets, it can be quite uncomfortable to be focused on something that keeps going down or that bounces too much. Of course, we care about price performance. No point in having instruments that pay you dividends and keep going down in terms of price. But I think the last slide clearly shows we are not losing in price appreciation. But if I focus my mind on my dividends income, I'm looking at something that only goes up, independent of market mood. And it becomes quite easy to hold our companies during down periods. Actually, if this mentality is really rooted in me, I may even hope for bear markets. Let's take a look at Broadcom's dividend yield over time. During the COVID crisis, because together with all companies, it has been beaten down and it continued to increase dividends, its dividend yield reached more than 6%, a great opportunity to start a position, almost 10 times higher than the current level. Next advantage, and my least favorite one. Dividend growth companies offers downside protection for extended down market movements. Let's see Roper Technologies dividend over time. We can see that at least for the past 10 years, it bounces between 0.5 and 0.7%. It seems that the market prices a maximum level of dividend yield for this company, which, when reached, it seems that the company recovers price performance. I think it happens because investors like myself like to start their positions when the companies are scoring their highest levels of dividend yield in relation to their historical levels. This increases demand for the stock, triggering a price recovery. I don't like this so much because I hate expanding past correlations into the future. I don't believe in this. Still, I like the approach of buying companies at their highest levels of yield, not because I expect an imminent price action, but in this way, I accelerate my income cash flow. But there are people who believe in this correlation, and that's why I put it here. Last advantage, not having to switch from growth to income investing. Growth investors will invest that way for the majority of their lives, and at some point, they're gonna have to transition into income investing or apply the 4% rule or something similar. That may be not an easy or comfortable change, yet it is not given that these strategies will grant increasing income over time. Dividend growth investors, on the other hand, will start their investing life buying dividend growth companies and will do that for the rest of their lives. We started buying cash flow from the companies now and won't have to change strategies in the future. Yet, at retirement, even if we have to consume all our dividends income, in the next years we are going to receive more because the companies will keep increasing their payouts. Therefore, we are big fans of DGI because 1. As a strategy, it already filters out most of bad companies. 2. We are not compromising price appreciation, maybe quite the opposite. 3. It is psychologically more comfortable to follow such a strategy. 4. There could be some downside protection to extended red markets. And 5. We will have guaranteed increase in income over time, even during retirement. Before we finish, let's take a look on the type of companies present in the dividend growth realm. On one side of the equation, we have companies like Realty Income, which present not great growth prospects and because of that, poorer price performance in comparison to the market. For some reason, people think that all dividend growth companies are represented by this profile, but that's far from the truth. We also have companies like Oracle on the other side of the equation, which, as any other dividend growth company, keeps increasing their payments over time, but also present explosive growth potential and price performance. So, if we put this concept in a graph, taking a look at growth and dividend yield for each company, the companies that we have seen today in the presentation would fall more or less like this in this graph. One spectrum with high yield and low growth, and the other side with low yield and high growth. This is a typical trade-off in this realm. I prefer to focus my attention on companies in this group and try to break this trade-off by using my own version of the dividend yield theory. I want to acquire the high growth companies when they will be presenting their highest levels of dividend yield, and therefore acceleration my income stream, keeping the high growth potential. But we'll see this in detail in another video. Also, for future videos, we'll be dispelling the most common myths about DGI. When I try to talk about it, the first three things I hear are, but dividends are discounted from the share price, companies pay dividends when they have nothing else to do with their money, or the alternative, dividends are paid by companies with no growth prospects, and another classic one, share buyback programs are better. And we are going to discuss about these comments in a future video. That's it. I hope you guys have liked my first ever YouTube video. Please leave a comment with some feedback or requests for future content. I would love to hear about it. If you can, leave a like and subscribe, and I'll see you in the next one. Thank you.